invested $500 every month at an interest rate of 7% annually, you'd have $1 million in 37 years. I mean, you've heard it hundreds of times. Invest your money for as long as possible and you'll build wealth pretty much automatically. It's all over YouTube, in finance books, and in motivational speeches. But if it's actually that easy, why aren't we all millionaires by now? That's what we'll talk about in this video. Most people believe that if you just save a small amount of money each month and invest it into something like an index fund, you'll wake up a millionaire at retirement. That's the common take, and it's logical and kind of makes sense. But here's the contrarian reality: compound interest does work, but only if your behavior, your circumstances, and your mindset line up with it. And for most people, to be honest, they don't. So let's start with the math, because that's the part that everyone quotes. Compound interest means that you earn interest on the original amount of money that you put into the account, plus also on the interest that you already received. So over time, this creates exponential growth. So imagine you invest $100 a month and earn 7% per year. In the first couple of years, these earnings are peanuts. But after 30 years, you'll have contributed about $36,000. However, thanks to compounding, your balance would be roughly $120,000. So that's more than triple the amount that you put in. And the earlier you start, let's say you begin at 20 instead of 30 years old, the bigger the difference. Many financial gurus love to show you that if you start saving $500 a month at 20 years old, you'll easily have $1 million or more by the time you retire. So why doesn't everyone do this? Why isn't everyone rich from compounding? Well, the first reason is pretty simple. The timeline is brutal. Compounding is like planting a tree. In the first few years, you see almost no growth. It feels like nothing's happening. But then, after a decade or two, the growth finally accelerates. But during those early years, when it feels like watching paint dry, most people lose patience or can't maintain steady contributions. That's why compound interest feels like a lie, because it feels painfully slow in the beginning. And the only people who make it to the fast growth part of the whole system are the ones who stick around for decades. So now let's add real life into the picture. Financial advice online often pretends we live in a vacuum. No layoffs, no children, no aging parents needing care, no sudden medical bills. But the truth is, reality couldn't be any further from that. I mean, think about your own life stages. In your 20s, you might be paying off student loans or barely covering rent. You're not in your high earning years yet, and saving even $100 a month might feel impossible. In your 30s and 40s, maybe you earn more, but life also gets more expensive. You buy a home, you have kids, you pay for education and deal with unexpected emergencies. You might have short periods where you can invest aggressively, but just as often you have to stop, maybe pull money out, or even skip contributions entirely. Later in life, maybe you do reach a point where you can save large amounts, but by then, time is no longer on your side. Even if you invest heavily in your 50s, you've lost the decades of compounding magic that early savers enjoy. So whenever you see those graphs of 30, 40, maybe 50-year-long savings periods, ask yourself, who are these people that can consistently save significant sums for that long? It's actually an exception. And this is why most people never reach the millionaire status through compounding alone. It's not because they're bad with money, it's because life is unpredictable, and linear savings plans rarely survive contact with reality. One issue many people underestimate is the actual savings rate that you need to have to achieve those numbers everyone online is talking about. Because saying, well, you need to save $500 every month is a lot easier than actually doing it. Voluntarily reducing your available income by a couple $100s each month is a lot more significant, has a much bigger income on your life and your lifestyle than you might realize. Besides that, only $500 per month might not even get you to your dream number. If you actually want to achieve a few $1 million to live off of for the rest of your life, you probably have to save somewhere north of $1,000 per month. But how realistic is it to even save $1,000 per month? Let's look at the median income in the US and in Germany, just to have some variation. In Germany, the median income after taxes is roughly 2,700 euros per month. In the US, it's around $5,000. Of that, imagine you could save around 15 to 20%, which is already above average. The Germans save on average between 10 to 12% of their net income. So let's say we'll listen to the 50-30-20 rule and actually get to save 20% of our income, which again is a lot. So a person with the median salary in the US would be able to save $1,000. Now the question is, who are these people that have a median or above median income in the US? Usually not people in their 20s. So if we now look at how many years it would take you to reach the first million, you'd need 28 years of consistently saving $1,000 every month to reach the number, adjusted for inflation, which is still far away from being financially free. And if we look at Germany, we'd need 34 years to get to $1 million or 36 years to get to €1 million. Again, these numbers are already adjusted for inflation. Now, if we want to reach $2 million, which is roughly where we start getting to the point where you can actually live off of long term from that amount of money, with a savings rate of $600 every month, which is roughly what we used for Germany in the past example, you'd need roughly 45 years to get to $2 million, which is only 10 years longer than to get to $1 million. And with a full $1,000 savings rate every month, you'd already be there after 36 years, which is only 8 more years after reaching your first million. The point is, your savings rate has a massive influence on how fast you reach the goals you set yourself. But this only becomes visible and significant after many decades, which is why many people are not exactly motivated to put money aside each month for $3.56 in interest. But even if we could save consistently, there's one more problem: human psychology. We are wired to value immediate rewards over future rewards. Economists call this the time preference. There's a classic experiment where children were offered 1 marshmallow immediately or 2 marshmallows if they waited 15 minutes. Many kids grabbed the 1 marshmallow, and adults aren't much different. We'd rather enjoy a vacation now than invest that money for a future that we can't see yet. Here's a practical example. Imagine you have $100 today. You know that if you invest it, in 10 years it could become $200. But that future $200 feels abstract, while the $100 today feels real. And each time we make that choice, we rob our future selves of compounded gains. And this isn't because we're dumb, it's because it's natural. Our ancestors had to prioritize immediate survival. The concept of long-term investing didn't really come up when deciding whether to eat caught fish today or in a month. And this psychological bias destroys compounding. It's not that compound interest doesn't work, it's that most people never let it. They cash out investments too early, they stop contributing, or they panic and sell when the markets drop. But here's the good news: you can outsmart that part of your brain. So let's take a short behavioral detour. The key is to design your environment so that you don't rely on willpower alone. First, automate everything. Set up your bank or brokerage account to move money automatically into investments each month, because if the decision is manually, you're way more likely to just skip it. Second, use commitment devices, like retirement accounts that penalize early withdrawals, or fixed deposits that lock your money that makes it harder for you to sabotage your future self. And third, frame savings in personal terms. Don't just say, I want to save this amount of money. Think, this $200 every month is future security for my kids, or this money will buy me freedom to travel by 2035. Concrete goals are much more effective than just abstract numbers. And finally, and this is probably the most important thing, surround yourself with people who save and invest. Money habits are contagious. Apps and peer groups where you can share progress can make saving feel rewarding already today. In all of those calculations, most finance YouTubers calculate with an annual return of 7%, which is the historic average of the stock market. We use this number because we think it's the best option for most people, because it's a combination of relatively low risk and high reward long term. However, this number is historic, and it doesn't mean it's going to stay at 7% in the future. It might be higher, it might be lower, and in some cases, in some periods, it might even be negative, even if the theoretical economic trend is going to be upwards. By the way, if you're interested in why the long-term trend of the stock market is always upwards, I'm already scripting a video about this, so make sure to subscribe to not miss that. The thing is, no one can guarantee or promise you that you're actually gonna get the 7%, and that's what makes people doubt the whole concept. They think it's like gambling, but I'll explain in more depth in the other video why that isn't the case. What can, however, eat away all your returns, or a big portion of them, are fees of all different kinds. Be it your account at the brokerage or bank, the TER of the fund you're investing in, or trading fees, and so much more. Banks are really creative in charging you fees, so be aware of that and make sure you actually get the return that you expect. Because not only your gains, but also your losses in the form of fees in this example have exponential consequences. So just a tiny fee that seems really small now might be costing you thousands of dollars in the future. Another thing is inflation. The number 7% is already adjusted for inflation. In the last 100 years, the S&P 500 index rose by about 10.2% annually, with an average inflation of 3%. That's how we got to the 7% number. But we don't know how high inflation is going to be in different parts of the world in the future. It might be better than expected, but it might also be worse. So compound interest isn't a myth. It's math. But math alone doesn't make millionaires. People don't end up rich from compounding because life interrupts their plans, because we're wired to value the present over the future, and because many of us never stick with investing long enough to see the real magic happen. We talked about why compounding feels slow, why life stages interrupt saving, and how our own psychology works against us. We explored behavioral tricks to fight these tendencies, and we visualized how wealth actually grows like a snowball, and we saw that starting small and early beats starting big and late. So you might not become a millionaire tomorrow, but decade by decade, you'll build financial security, freedom, and the ability to live life on your terms. Thank you very much for watching. Subscribe to the channel and drop a comment below. Have you started early or you're starting now? I'd love to hear your journey. Thank you very much, and I'll see you in the next video.